Silver just got obliterated, down 19% in a matter of weeks. Red candles stacking like a horror movie, volume exploding, stops getting hunted. Everyone's calling it a healthy pullback, or buy the dip. They're wrong. This isn't a dip. This is the first visible crack in a system that's been quietly breaking for months. The real trigger wasn't some Fed speech or geopolitical flare-up. It was a sudden, brutal collapse in global industrial orders. Factory cancellations, solar projects put on ice, EV lines scaled back, all hitting at once. The data dropped quietly, buried in PMI reports and earnings calls, while the price screamed. And the worst part? Almost nobody saw it coming. The analysts, the banks, the biggest bulls, all blindsided, because they were too busy believing their own story. For over a decade, they sold you the same dream. Silver is the ultimate green energy play. Solar panels, electric vehicles, 5G infrastructure, endless industrial demand that could only go one way, up. Bank reports with hockey stick forecasts, CNBC segments calling it the trade of the decade, YouTube gurus screaming about shortages and short squeezes. They never told you the other side. They buried the growing inventories, the substitution risks, the fact that many of those irreplaceable uses could switch to cheaper alternatives when prices got too high. They ignored every historical precedent of overhyped industrial metals. Remember lithium, rare earths in 2011, platinum in 2008? All rode the same wave of unstoppable demand narratives, right until reality hit, and they crashed 70 to 90%. This 19% plunge isn't an accident. It's proof the silver narrative was always built on sand. The story was fragile from day one, and now the tide's going out. Silver has two faces. About half its demand comes from industry: electronics, solar panels, medical devices, automotive catalysts. The other half is investment and jewelry. In bull markets, everyone focuses on the shiny investment story: monetary metal, inflation hedge, poor man's gold. But the real driver of explosive price moves has always been industrial demand. When factories are running hot and ordering silver like crazy, the price rips higher. But when those orders vanish overnight, the entire structure collapses. Because the price isn't set by physical bars in your safe. It's set in the futures market, a highly leveraged paper casino where positions are 50, 100, even 200 times larger than annual mine supply. One demand shock hits, prices slide, margin calls go out, forced selling begins, and the whole thing accelerates into a liquidation cascade. When industrial buyers disappear, the house of cards doesn't wobble, it falls. And that's exactly what we're watching right now. Here's where it all snapped. This wasn't some slow, predictable slowdown. It hit like a blackout. Within a span of just a few weeks, major solar developers in Europe and the US quietly shelved or delayed gigawatts of new panel installations. Chinese manufacturers, who dominate global supply, reported order books shrinking fast as inventories piled up. At the same time, automakers started cutting EV production targets. Factory lines slowed, battery material orders trimmed. Look at the PMI numbers. Global manufacturing PMI dropped sharply into contraction territory, with new orders sub-indexes flashing red across China, Germany, and the US. Earnings calls from major solar and EV players were littered with phrases like demand softening, inventory adjustment, and project deferrals. These weren't gradual shifts. They landed suddenly, almost in sync, catching the entire silver market flat-footed. Leveraged positions that were built assuming endless growth got blindsided. The catalyst wasn't one event. It was a cluster of cancellations that exposed the fragility all at once. Now put yourself in the shoes of the big leveraged players. These funds, banks, and trading desks had stacked massive long positions in silver futures. betting everything on those perpetual industrial growth forecasts. Contracts layered on contracts, leverage running hot because demand can only go up. When the spot price started sliding on those initial order cancellations, the trap sprang shut. Margin calls came fast. To meet them, they had two choices: pour in fresh capital, impossible in a risk-off environment where no one wants to catch a falling knife, or liquidate positions immediately. Most chose liquidation because there was no third option. The system itself forced their hand. It's a structural trap. The higher the leverage on the way up, the more brutal the forced selling on the way down. No mercy, no escape. Once the selling started, it didn't stop. It accelerated. Here's the domino logic, step by step. Spot price drops on weak industrial demand. First wave of margin calls hits. Traders dump contracts to cover. Increased selling pressure drives the price lower. More margin calls. Stop-loss orders trigger automatically. Volume explodes as algorithms pile in. ETFs see outflows and are forced to sell underlying futures. Price plunges further. Even more stops get hunted. It's a self-feeding spiral. You see it in the charts: accelerating downside volume, widening bid-ask spreads, cascading red candles. And it gets worse. Mining companies that hedge production forward at higher prices now lock in those lower levels, blunting any future supply response. The cutbacks they'll eventually make come too late to stop the current washout. The cascade doesn't pause for breath. It just keeps grinding lower until every weak hand is shaken out. Major hedge funds that were loudly bullish 6 months ago quietly closed out massive long positions at a loss. Bullion banks that facilitated the trade found themselves on the wrong side of forced liquidations. Giant silver ETFs bled assets as retail panicked. You can track the CFTC commitment of traders reports. The managed money long category got eviscerated in weeks. If these institutions, with the best data, the deepest pockets, the direct lines to industry, couldn't slow the slide, what chance did anyone else have? They tried. Some doubled down early, only to get margin called harder. Others hedged too late. The market didn't care about reputations or balance sheets. It steamrolled everyone in its path. That's the message here. When the mechanics flip, control is an illusion. This is where the real disconnect shows up. Paper silver versus physical. The 19% move you saw on your screen, that was almost entirely a paper phenomenon. Futures contracts, ETFs, unallocated accounts getting liquidated in a leveraged frenzy. But physical silver told a different story. Delivery queues lengthened, dealer premiums spiked, and allocated bars became harder to source at spot price. Why? Because paper markets are inflated by leverage. Hundreds of claims on every real ounce. When panic hits, paper can crash overnight. Physical can't. The price on your app isn't the price you'd pay if you demanded delivery today. That gap widened dramatically during this plunge, exposing the divide. Trusting the screen price as real is dangerous when the system is built on promises, not metal. Every crash like this is a wealth transfer. Plain and simple. Winners: the commercial shorts, producers who hedged early, banks that positioned defensively, cash-rich physical buyers who waited patiently and now load up at lower levels with premiums still reasonable. Disciplined bears who saw the cracks forming. Losers, the leveraged bulls who got margin called out, ETF holders watching their shares evaporate, high-cost miners whose projects just went underwater as cash flows dry up. Billions moved from weak, overexposed hands to strong, prepared ones in weeks. It's not random. It's the market doing what it always does, punishing conviction in a broken narrative and rewarding those who respected risk. Watch what they do, not what they say. Central banks keep stacking gold quietly, record purchases continuing. But silver? Almost zero interest. Industry executives in solar and EVs aren't sounding alarms about shortages anymore. They're guiding lower on silver intensity and exploring substitutes like copper or aluminum alternatives. Mining CEOs have been trimming personal shareholdings and pulling back CapEx guidance, delaying new projects, conserving cash for the downturn. Smart money isn't fighting this tape. They're not buying the dip aggressively or calling for a squeeze. They're positioning for lower prices, reduced demand, and a longer grind. When insiders act this way, it's the loudest signal there is. Time to bury the old silver bull playbook. Silver always outperforms gold in the late stages of a bull market. Dead. Industrial demand growth is unstoppable. Dead. Massive short position means an epic squeeze is coming. Dead. Buy every dip because shortages are permanent. Those mantras worked in a world of expanding credit and green euphoria. They don't work in demand destruction and deflationary forces. The environment flipped. Clinging to legacy advice now is like fighting the last war. The old rules aren't bending. They're broken. And anyone still quoting them is about to learn the hard way. This isn't just some abstract chart porn happening in a vacuum. It's already hitting the real economy, and it's coming for your world next. Those canceled solar projects and scaled-back EV lines mean factories are idling. Orders aren't coming in, so production gets cut. Workers get laid off or hours reduced. Paychecks shrink, spending pulls back. The multiplier effect kicks in. Less money circulating means retailers see slower sales, suppliers get squeezed, more cutbacks follow. Silver's crash isn't lagging noise. It's a leading indicator. When industrial metals roll over this hard, it's screaming that broader manufacturing is in trouble. We're not talking about some distant emerging market problem. This is happening in China, Europe, the US, the engines of global growth. If you work in tech, auto, construction, energy, or anything tied to discretionary spending, this meltdown is a warning shot. The pain is just starting to spread. Now watch how this turns into a self-reinforcing doom loop. Lower silver prices make marginal projects uneconomical. More solar and EV developments get deferred or canceled. Industrial silver demand falls further. Inventories build higher. Prices get pushed even lower. More projects go on ice. Manufacturers accelerate substitution to cheaper alternatives. Demand evaporates faster. Mining companies slash exploration and delay new capacity. But those supply cuts only matter years from now. Meanwhile, recession fears feed the cycle. Consumers tighten belts. Corporations hoard cash. Governments pause green subsidies and budget crunches. Every step lower validates the bear case and encourages more caution. There's no circuit breaker here. The loop keeps tightening until something external shocks it, or until the washout finally exhausts itself after extreme pain. We're deep in that loop already, and it's accelerating. This isn't new. We've seen this movie before, and it always ends ugly. Go back to 2008. Platinum rode the auto catalyst boom, hit all-time highs, then collapsed over 60% as car production seized up in the financial crisis. Copper, the doctor of the economy, dropped 70% as global construction and manufacturing froze. Silver itself got wrecked twice. In 1980, after the Hunt Brothers corner failed, plunging from $50 to under $5 in months. Then again in 2008-2009, when industrial demand vanished. Common threads every time. Over-leveraged bulls convinced this time is different. Sudden demand destruction no one priced in. Multi-year bear markets that ground prices lower as hope died slowly. The recoveries only started after capitulation. Years of pain, not weeks. Silver today is echoing those patterns beat for beat. Ignore history if you want. The market won't. We're not in the old regime anymore. The page has turned. The 2010s and early 2020s were defined by green growth euphoria, cheap money, endless stimulus, mandates pushing solar and EVs no matter the cost. Silver surfed that wave as the poster child growth metal. That era is over. We've shifted into industrial contraction, tighter liquidity, and deflationary pressures. Demand isn't expanding forever, it's shrinking, and substitutes are viable when prices stay elevated too long. Silver isn't the scarcity play or the green darling anymore. It's morphed into a recession barometer, highly sensitive to manufacturing health, quick to signal trouble. The psychology has flipped. Bulls are exhausted, bears are emboldened, and the narrative has permanently changed. Welcome to the new phase. Fighting it is futile. Here's where it gets empowering, if you're paying attention. Most people will keep clinging to the dead narrative, buying every dip, waiting for the squeeze that never comes, and getting ground down slowly. But those who recognize the regime shift early can survive, and even profit. Knowledge is your edge now. Understanding that we're in demand destruction mode lets you position defensively. Reduce leverage, prioritize physical over paper, keep cash dry for when premiums compress at real bottoms. Or go opportunistic. Watch for short setups or deep value physical accumulation when panic peaks. You don't have to predict the exact bottom. No one can. But seeing the new reality clearly separates the casualties from the survivors. The market will keep punishing the crowd. You don't have to be part of it. Here's what you can actually do right now. No hype, no magic bullets, just practical moves that align with the new reality. First, prioritize physical over paper. If you're still heavy in ETFs, futures, or unallocated accounts, start rotating out. Paper got vaporized in this cascade because it's leveraged and abstract. Physical didn't. Premium spiked for a reason. Real metal held value when the screen price lied. Dealers are still reporting tight allocated supply even after the spot drop. Get coins or bars from reputable sources. Pay the premium if you have to. And store it yourself. No counterparty risk, no liquidation forced on you. Second, track the data that matters. Forget the headline price. Watch industrial PMI, new orders subindexes, solar installation forecasts, EV production guidance. Those are the drivers now. When they stabilize or inflect, you'll see it before the crowd. Also monitor physical premiums and COMEX delivery volumes. Widening gaps signal stress. Compression signals potential exhaustion. Third, keep dry powder. Cash or stable assets. Timing the exact bottom in these crashes is impossible. They overshoot, they grind, they fake rallies to trap buyers. But when capitulation finally hits, the strongest opportunities appear. You want to be able to act without selling something else at the worst moment. This isn't the complete playbook. I'm not handing you every tactical detail in one video. Some edges need deeper explanation, real-time updates, and specifics that change week to week. But these steps alone put you ahead of 95% of the market still operating under the dead rules. Recognize the regime, act accordingly, and you dramatically improve your odds of coming out the other side intact or even stronger. This move is still alive and breathing. New data hits every week. PMI flashes, earnings revisions, project announcements. Any one of them could accelerate the slide or hint at the final washout. Waiting for confirmation or clarity means you'll keep getting run over. The meltdown isn't finished until the last bull throws in the towel. If you want to stay in front of what's coming, the next wave down, the signals that actually mark capitulation, the precise positioning for when this finally bottoms, you need to be locked in. Hit subscribe right now and turn on notifications.